This is Nicole, and this video is about stock replacement, understanding cost of carry, and put-call parity. In this video, we're diving into understanding cost of carry when analyzing a popular portfolio management strategy that's been around for years: stock replacement using call leaps plus T-bills. This strategy combines two simple components: long-dated call options and treasury bills, to replicate stock exposure in a more capital-efficient, risk-aware way. Today, I'll walk you through what stock replacement with leaps actually looks like, how cost of carry is embedded in option pricing, and how put-call parity reveals what you're really paying for when you use this strategy. Let's briefly review what leaps are. Leaps are simply long-dated options, usually with expirations longer than 9 months and often up to 2+ years in the future. Stock replacement is a strategy where instead of buying and holding the underlying stock, you buy a deep-in-the-money leaps call option to replicate the stock's price behavior, freeing up a large portion of your capital in the process. When you buy a call leaps, you're essentially obtaining stock exposure with far less capital. This is capital efficiency at its core, controlling significant positions while freeing up cash for other opportunities. To demonstrate this concept, let's hop into the tastytrade platform where I have SPY populated in the Trade tab. And first, let's look at what the cost would be to purchase 100 shares of SPY. And we can see here that at the current market price, it would cost us $62,784 to purchase 100 shares of SPY. Now, let's compare that to buying a deep-in-the-money call leap for stock replacement. And I am going to open up the December 17th, 2027 expiration cycle. And these options expire in 878 days. And I'm interested in buying a 75 delta call option here. So I scroll down the options chain and we can see that in order to purchase a 75 delta call option, I would be looking at buying the 515 strike call. And if I hit the ask there, it's going to populate the trade ticket. And we're going to see that that would give us exposure of 75 delta, and that would cost us $16,970. And that position would behave as if I owned 75 shares of SPY, with prices currently being where they're at. So if we wanted to really get accurate here and compare apples to apples, we want to compare that price to actually buying 75 shares of SPY. So let's go ahead and populate the cost to purchase 75 shares of SPY. And we can see that the cost to purchase 75 shares of SPY is equal to $47,079. So even when we delta adjust for notional exposure, we can see that the cost to purchase the call leaps is going to be significantly less than the cost to purchase even 75 shares of SPY. So for me, stock replacement with leaps is about opportunity cost and capital efficiency. In the previous example, instead of using roughly $62,000 to buy 100 shares of SPY, I can control nearly the same exposure by spending roughly $17,000 on an SPY call leap, leaving over $45,000 free to invest in T-bills or other investments. I still get the upside exposure, but I preserve capital and keep optionality. Now let's talk about leaps call option pricing. The leaps call price consists of intrinsic and extrinsic value. Intrinsic value is the profit you'd make if you exercise the option right now. It's real and immediate. Intrinsic value is equal to the stock price minus the strike price. Extrinsic value consists of everything else: time value, volatility premium, interest rates, etc. It's the what-if value, and extrinsic value is equal to the option price minus intrinsic value. And it's important to note that all options have extrinsic value. So this time, let's hop into the Thinkorswim trading platform here to demonstrate what I just discussed. I have SPY populated in the Trade tab, and I'm going to scroll down to the January 15th, 2027 expiration cycle. These options expire in 527 days at the time of this filming. And I think I'm going to reduce the number of strikes listed in the options chain just for ease of demonstration. There we go. And you can see here that I am able to select the criteria for the information listed in the options chain on a drop-down menu here, and I'm interested in taking a look at intrinsic and extrinsic value. So here the columns list position, intrinsic and extrinsic value, and I'm just going to change the position to delta, just because that's what I like displayed. So I have delta, intrinsic, and extrinsic value, and that's listed for both the call options and put options. This video is about call options, so that's what we're focusing on. And when I highlight the extrinsic value for all the different strike prices listed, you can see that all of the strike prices have extrinsic value. Even the options that are deep in the money. It's important to understand that a significant portion of the extrinsic value in a deep in the money call option isn't just option premium, it's the embedded interest rate. And why is this? Well, because when you buy a call instead of stock, you don't have to put up all the capital. You can hold the rest in T-bills. Option pricing models like Black-Scholes assume that cash earns the risk-free rate, so the option price adjusts accordingly. Higher interest rates mean higher extrinsic values for call options. As of August 5th, 2025, the risk-free rate is about 4.34%, and that assumption is baked into the price of the LEAP's call options. So let's take a look at what that looks like in real practice. Let's hop into the Tasty Trade platform here to demonstrate what we just discussed. It might be a little bit easier to understand when I take you through an example. I'm going to open up the January 15th, 2027 options expiration cycle, and the left-hand side of the options chain displays information for call options. And I am interested in purchasing the 75 delta call option in this expiration cycle. And when I scroll down the options chain here, it looks like I would be purchasing the 530 strike call option. And I am going to click on the ask to populate the trade ticket. And we can see here that it would cost us $13,956 in order to purchase that call option, which would give us exposure of 75 delta. So this position would replicate owning 75 shares of SPY. Now let's calculate what it would cost to purchase 75 shares of SPY so that we're comparing apples to apples. And you can see here in the platform that it would cost us $47,292 to purchase 75 shares of SPY at current market prices. And now I want to calculate the difference between what it would cost to purchase 75 shares of SPY and what it would cost to simply purchase the deep in the money call leap. So I'm going to take the $47,292 to purchase 75 shares of SPY and subtract $13,956, which is what it would cost to purchase the call leap. And we have remaining cash of $33,336 that in theory we could invest in T-bills. And we know that the risk-free rate of return for T-bills is just over 4%, and that's annualized. And we know that this position expires in 527 days. So in order to annualize this, let's take the 527 and divide it by 365. And we get 1.44 plus years, and we're going to multiply that times the risk-free rate, which is 4.34%, and we get a return of just over 6% on the $33,336 of cash that we didn't have to use to buy 75 shares of SPY. And when we multiply that times 6%, we get $2,088. Now, let's scroll down to the 530 strike call option and see how that plays into the extrinsic value of the options. So the extrinsic value for the call option that we would be purchasing is $38.94, and equities have a 100 multiplier, and prices are bouncing around a little bit. So it looks like the extrinsic value for that call option is around $3,900 or so. So if we take we'll use current prices here, $38.95 of extrinsic value, and multiply that times 100, we get $38.95. And if we subtract the amount of interest that we'd earn on the cash that we didn't have to use to purchase 75 shares of SPY, we get a remaining value of $1,870. And lo and behold, that is very close to equal to the extrinsic value on the put side. So this demonstrates something called put-call parity. Put-call parity ensures fairness in the pricing of calls and puts at the same strike and expiration. After removing the interest rate component, the remaining premium matches the equivalent put option's extrinsic value, confirming correct pricing and risk symmetry. So extrinsic value of the call option minus the interest you can earn with the risk-free rate is roughly equivalent to the put price. And a little caveat here is that you can expect some deviation with American-style options when applying this concept. In American-style options are most equity options traded on U.S. exchanges. And this is because these options carry the risk of early exercise. So the true cost to carry will be somewhere within the bounds of what put-call parity describes. It won't be the exact value, but it will be very close. So who really cares? Well, by knowing this breakdown, you can see that a large portion of the drag or cost of carry for the LEAPS call option is actually offset by the interest you earn on the cash you didn't use to buy the stock, provided you actually invest that cash in T-bills or similar instruments. The remaining non-interest portion of the extrinsic value roughly matches the same strike put premium. This is what you really pay for optionality, and it is often much smaller than the total extrinsic value. So when analyzing stock replacement, remember, a large portion of extrinsic value is offset by T-bill interest if you actually invest the freed up cash, and the real cost is close to the residual put equivalent premium. So let's bring this together. LEAPS plus T-bills create capital efficiency, which provides stock-like exposure for less capital. Extrinsic value includes cost of carry, so don't mistake interest for wasted premium. And put-call parity explains this breakdown. The true optionality cost is much smaller than it looks. With this precision, you can manage stock replacement strategies more effectively, set realistic expectations, and even offset residual costs by selling short-term premium around your LEAPS position. This video is for educational purposes only and does not constitute investment, financial, or trading advice. No recommendations to buy or sell securities are being made. All examples are hypothetical and for illustration only. All investments carry risk, including the possible loss of principal. Options trading involves significant risk and is not suitable for all investors. Past performance is not indicative of future results. Consult a qualified financial advisor before implementing any strategy and review your financial situation, risk tolerance, cost, fees, and tax implications. Options trading requires broker approval, and not all strategies are permitted in all account types. Returns shown are hypothetical and not guaranteed. Market conditions may change quickly, and results will vary based on market performance, timing, and execution. Read characteristics and risks of standardized options from your broker or at www.optionsclearing.com before trading options.